Hey folks, Colby here with Volatility Capital Management. Hope you're having a great day so far. Obviously, I've been hearing quite a bit about market volatility recently, and wanted to, because I'm a nerd at heart, love these numbers, love your financial plans, your cash flow reports, your income tax comparisons. Man, love it. Thankfully, you have me, so you don't have to sleep through that stuff. But in all seriousness, really want to talk with you guys about market volatility, both now and moving forward into the future, and just some things that we've kind of seen in the past. But before I talk about that, I just want you to know that we know this is highly emotional. This is a big deal. Yes, you have money in the market that is fluctuating in value, but there's also wars and pandemic and uncertainty going around. So we just want you to know, Mike and I want you to know that we understand that completely. We are here for you guys. You need to have a conversation with us. Let's have a conversation. We know how crazy this time has been, how crazy this world has been. So really, when we're looking at this, though, number one, you need to have a plan, right? You need to be able to manage your cash flow, manage how you save your money. Are you saving in the right spots to be efficient for taxes in the future, for income in the future, everything across the board? Because oftentimes what we see is if you don't have a plan and maybe you're investing money that you shouldn't be because it's money you need in 6 months to a year and you see the market going down, well, that might give you some heartburn. So just know that on a practical side of things, we can really help with that in terms of saying, oh, you need to buy a house or a car or there's tuition due soon. You should probably keep that money in cash, save it, making sure it's going to be there. But what about the long-term money? How do we mentally and psychologically kind of deal with the fact that you're going to see a lot of these fluctuations? So wanted to go through, and we came across this exceptional article that Franklin Templeton wrote, and they went and pulled some research from a few focus groups, Ned Davis research. And essentially what they found is that if they were looking at the Dow Jones as the main market index, following a bear market, and again, a bear market is a 20% sell-off from the prior high, what they're really seeing is, hey, on average, if you kept your money in this index for an entire 12 months following that big sell-off, what does that kind of look like? And really what they've seen is if you keep your money in that position for the following 12 months after we reach that low point, on average for that 12 months, the positive rate of return in terms of a rebound was a little over 38%. So that right there goes to show you, don't live in the short-term fluctuations, the 5, 6 month, year or two fluctuations. You need to look at this with a broader vision, market cycles, that kind of a thing. But the other thing that we see happens is, let's say you move to cash near the very, very, very bottom of a bear market. On average, if you keep your money in cash for 6 months is all, and then put your money back into the stock market, your average in terms of your rebound drops 30-ish% down to just over 8% on average. Tremendous difference for 6 months of time, 6 months of a wait. So just know that we can help make sense of this for you. There are things you can put in place that won't have the short-term movements like this. But let's talk about the broad market really quick. Now we'll shift gears, the S&P 500. If we look back 20 years, looking at the end of 2021, we've had quite a bit of volatility. In fact, if you look at statistics of the S&P, typically we see that 70% of the time the S&P sometime in the year goes down at least 10% before going down further, going back up, whatever it would be. But we know that it happens more often than not, 70% of the time. So if you stayed invested in the S&P 500 from the end of 2021 going backward 20 years, your average is 9.52%. You stick in there, you ride the waves, you go up, you go down, you bite your pillow because you're watching the news and you just can't handle it anymore, but you stay the course, 9.5% average for 20 years. That's great. If you miss the best 10 days in the market, and I mean for the entire 20-year time frame, not 10 days per year, your average rate of return drops substantially, closer to 5.5%, just underneath that. And it gets even worse. You miss the best 20 days for the entire 20-year time frame, your average drops down to 2.6%. You miss the best